Hi, everyone. Welcome back to Friends of Mortgage Heroes. I'm Andy, and today I have a very special guest. This is my friend John Lloyd with Fidelis Pivate Fund. And John and I actually have known each other kind of at a distance for a long time, and then more recently in greater proximity for a number of reasons, business-wise. But today we're going to specifically talk about private lending and private financing, because I think there's definitely a lot of misconceptions about it. There's definitely things people think they understand and then they don't. But then there's some things that we really should drill into that I know you specifically do that are helping people here in San Diego kind of cross the bridge of acquiring financing for real estate that sometimes might otherwise be a little more difficult to do traditionally.
Right.
Yeah. So let's get into all that. Let's take the high level first if we can. So can you kind of explain who's John? What's Fidelis? How long have you done this? And kind of what's the general idea here?
All right. Yeah, I've been in this business a long time, over 30 years, and I managed a mortgage fund for 12 years previously to Fidelis, where we did short-term bridge financing, brokerage. It was a fund where we raised capital, took the capital, lent it out, short-term bridge financing, primarily here in San Diego. And in 2019, I started my own fund, Fidelis Pivate Fund, and did the same thing. Took that business model, just amped it up, made it better. We take capital in. Our fund is currently over $70 million.
Wow.
Yeah, so we're doing short-term bridge financing, helping people get into investment properties, fix and flip, timing-related deals where they need funding fast and it's convenient, and it's expensive, but it's when we perform. That's what makes the difference.
Yeah.
Is performance.
Well, so a couple things right out the bat, right out the gate that you had mentioned. Well, first of all, you're saying the word expensive, but I think that's relative. I mean, it's relative to what that you could get in a traditional method, but that's not available. That's why this exists, right? So, let's unpack the idea of it being expensive a little bit.
Yeah. When I say expensive, to do compared to traditional financing, conventional financing, but. Like our borrowers, we do a lot of repeat business. Our borrowers really don't even ask us about pricing, just because, it's expensive, like I said, but it's performance. If they're getting a deal where they're saving $100,000, they don't care what the price is. If you can perform in a week, that's value, and we add value to our clients, and they're willing to pay for it.
So let's go into that a little bit, and let's kind of explain what you mentioned also in the beginning here. You mentioned bridge financing. So let's explain to people who may not know what that is. What's bridge financing? Why do people need it? And then what objective does it achieve in the marketplace?
So there's always a need for private financing. I mean, even I've been doing this, like I said, a long time, through the Great Recession, where we went through, we didn't lose a dime of investor capital.
Wow.
And which is unheard of.
Through 08, 09, 10,
right.
What?
So we took
that's crazy. That's unheard of, because
everyone
was losing their shorts and everything. The whole thing fell apart.
Yeah, it's
apparently not the whole thing.
Yeah.
So
and our yield went down on our fund a little bit, but no investor lost any capital. Just how you manage
that's crazy.
These loans and how you work with your clients. Do you treat them like you want to be treated?
Right.
And we did that. We didn't foreclose on everybody. We worked with them.
Oh, wow.
Got through that period. But going back to your question on what is bridge financing, and it's for people who need timing-related transactions. They need to close fast. If they have an acquisition that they got a discount on the price, they need to close it within 10 days, we're there to do it. If you're at a property that's in transition, there needs to be improvements. It's not capable of getting conventional finance just to the quality of where the property's positioned. Then we come in and help position that property into a point where you can get financing. And so those are the two. And then fix and flip type properties where they get in there fast, fix them, get out of it, and we're on to the next deal. So
that's a good transition, because I wanted to kind of describe to everyone watching here that might be new to bridge financing or new to private fund, like you're talking about, is what are the case situations? So you're talking about a fast close, but okay, why is a fast close necessary? How's the table been set that someone has to close that fast that traditional financing just can't get it done?
Well,
what kind of situation would you find yourself in?
Okay, they go to the buyer and they say, "We'll close. We'll give you this price, but no contingencies. We'll release all the contingencies. We'll close in 10 days." Mm-hmm. And sometimes a seller has been through escrow, falls out, goes through another escrow, through the contingency period. They're tired of this. And so
they're fed up.
They're fed up.
Okay.
So if they have a deal with all the contingencies released and close in 10 days, they discount the price, then that's when we come in, we help the buyer get the property and help the seller. It's a win-win situation.
So in this part, we're talking about sellers who might have been frustrated from the deals falling out, buyer who wants to get in, they need to get it done quickly, they want to get in and through escrow as fast as possible. This would be a great application of using private funds.
Yeah, perfect. Yep.
So you'd also mentioned something about yield before. So I know there's another side of this whole business which has to do with like capital raising, but let's talk about who are you raising capital for. So on the who, you're talking. I know that we're talking about like investors, people that are maybe buying places that are multiple units or multiple doors on the same place. So let's talk about some of those. What are like an ideal fit for you on the lending side? Like what are some of the things that you would like say, hey, that's a really good feather in our cap, some really consistent successes that you have in types of transactions?
Okay, yeah. Like you said, I have two sets of clients. I have investors who put money in the fund, accredited investors invest as limited partners. We take that money, we lend it out. That's my other client, the borrowers.
Mm-hmm.
And the perfect, I'll give you both situations. The best profile borrower is somebody who's, again, timing related transaction, or if they're construction related. A lot of these right now, it's ADUs are popular. We're doing a lot of ADU construction where it's transition. Mm-hmm. They need to add value to the property. We come in, we help them add that value. They get it stabilized, they sell it or refinance it. Mm-hmm. That's, again, another typical borrower situation. And then on the investor side, the limited partners, typically it's the investor who's owned a lot of real estate. They're tired of the ownership and they're tired of the... the
day by day stuff.
It's like they're sort of, they've done that and they're time to just collect income. It's a fixed income fund, so it allows them to put money in the fund secured by real estate. And currently, we're generating over a 9% return to our investors.
Wow!
So it's really a good investment opportunity for a long-term investor.
So have you found that some of those people that are doing that are jumping from managing their properties on their own and they skip the part where they have a property manager and then they just come to you to let the money do the work and just like they jump over that step? Or do these people already have like property managers and they're sick of that part as well? And now like, fine, I don't want to have anybody else or any property. I just want to put the money in something that's related to property and receive a return. Like what's kind of the situation?
It's typically they'll sell a few properties, have a liquidity transaction where they have a bunch of income, and do they reinvest that in other properties or do they put it in the fund? And that's where a lot of investors are, it's a diversification of the portfolio. It's not all their money. It's a piece of their portfolio where they can put it in and they can let it compound or they can collect fixed income. Yeah. And that return, your money doubles after 7 years at this rate. So it really grows, and it just, again, allows the limited partner to be secured by real estate in San Diego, which is very valuable. Yeah. And they know real estate in San Diego, so they feel comfortable, and to have that invested in a fund with our experience and our management experience in managing a fund, they feel comfortable, and it's been a good investment opportunity for them.
So it's a good use case. Yeah.
Yeah.
or not just a good use case, but a recurring use case, I guess is probably a better description.
Yeah.
Yeah. So you mentioned ADUs in construction. As you were saying that, I wonder if, and so I'm going to ask the question, and then I'll find out the answer for myself as quickly as you guys are all going to find out. So I wonder if you will finance deals that are partially done, where maybe something was started in the construction project, for whatever reason, financing dried up, the project ended, there was a problem, and then you're used to bridge to the conclusion of the construction financing. Is that ever a case too, or is that like me just making stuff up out of thin air?
No. I'm doing one of those right now as we speak.
Really? Okay.
The borrower, had funds to get started. They thought they had the funds to finish, so they're halfway through, and so we get the call, hey, conventional finance, there's no way they're going to do this. Can you help us finish this off? And so for us, that's a prime candidate for a deal. It's a little more risky, but we dig deep, and if it's a relationship we've done business with before, it's easy. If it's a new one, I really got to check the contractor, make sure the borrower's solid, and make sure we can finish on budget.
Okay, so thank you for answering that. That's great. So now that I know that, so let's go another step though. Tell me, like, what is, what's the culprit, without bringing shame upon anybody? Like, what's the culprit that someone to run out of money? Is it just material cost? Is it a poor relationship with the contractor? Is it that something in the municipality has changed since they started and now they have to do something else? Like, what are some of the conditions that would cause that to happen?
A variety of factors. Life happens to people sometimes.
Okay, that's fine. That's fine.
Life events that cause other cash requirements, and so some maybe their liquidity was moved to another part of their life they needed, so they lost some of that liquidity, or sometimes budget they go over budget. Typically, I mean, it's not a typical occurrence, but I just so happen to be working on one of those, so it does happen.
It's good timing.
So it's not something we're out looking for, because usually it's an issue that I need to make sure I feel comfortable about. If that happened, there's got to be a good explanation. And that's the difference for us. We dig deep and find out, hey, if there's an issue, maybe what's the reason behind this? Not just check the box like, hey, they started partially. We're not going to do it.
Well, that's what I was wondering, because I'm like, so I was asking the question out of curiosity at first, then I'm listening to you answer, and then I'm wondering, then that still takes a little bit of guts to say, like, yeah, I'll step in and help, because you maybe had to divert some money over here before. Well, what's to say they won't divert that money again? Yeah. I don't know. That maybe there's mechanically ways to do that, which may be important or not important. But I was just wondering, like, what's the caveat that would make you go, yeah, you know what, this is a good investment for us?
I think it's the people. It's relationships. Okay. I'd meet them. I figure out really what's going on with them. If I feel that it's legit, and our goal is to help people. And if we can do it, we're going to do it. And if I feel like it's risky to our investors, I won't do it. But I've been I'm experienced in this. I've done this for a long time. I understand the risks, and we're willing to take the calculated risks on deals like that.
One of the things, and I'll just make a pit stop here just quickly, because I know that from the outside looking in at finance and looking at mortgage and looking at real estate, there's a broad callousness towards the people and the system as a whole. Yeah. And I know that's not for everybody. I know there's lots of people that love real estate, and they've made tons of millions of dollars of real estate, and they have a house and they have a mortgage. So they kind of just hate it because it's popular, not because they really hate it. But that's interesting for you to say that, though, because so much of what we do in making decisions in lending comes down to just facts and figures and numbers. And there's always a personal story behind it, which is why you write explanation letters and you clarify things with underwriters. But sometimes those things can't overcompensate what the math says. So it's heartwarming. I guess it's heartwarming to know, you're like, hey, I'll take the personal side of this into consideration, because it may not be the only thing going on is what's on paper. It's rarely the case. It's whatever's on paper is the only thing going on.
Yeah, and that. I mean, again, I just want to emphasize it's security for our investors. I make sure that we're not jeopardizing the security for our investors. So there's got to be equity.
There's no upside to do that.
Yeah, so there's got to be equity in the property. But again, looking at, we make the decisions. We don't have somebody looking over our shoulders, making sure you check this box and this box.
Like some dark, smoky room and the lights are dim.
Yeah. Or regulators looking over, and we make the decisions, and we take the responsibility. I take the responsibility for every deal, and if I feel good about it and it's secured for our investors, we'll do it. But it's not always numbers driven. The equity's got to be there, but it's not. Sometimes on the surface,
part of it. You can't ignore that. You can't say, "Oh, you had a hard week. Let me just throw you some money."
Yeah.
That's not the. Yeah. I know that's clearly not the answer.
And I just want to emphasize that's not what we do.
I know that's not the situation. Yeah. But I'm saying, I think I'm trying to meet you where you're at in actually explaining that, because there are times where yes, there are unexpected things that happen, but that doesn't mean that the deal has to die too. Both things can be true at once. This other thing that could have happened in your life could have happened and caused you to redirect your focus focus for a while, but then you can still come back to this thing that you started and work it into completion. And I think that especially when things are uncertain in real estate, I think people think only one is true. Well, this has got to stop because I have to go do this. But it may just be temporarily. You can still come back to this thing that you're trying to accomplish, and it can still get done.
Yeah, I mean, life happens. I mean, I've looked at credit scores. Yeah, they're important, but somebody may have a bad credit score. We're going to dig deep, and why is it? Maybe it's a medical issue. Maybe they had
medical bills. Yeah,
something out of their control, and
Sure.
It wasn't because of their lack of paying bills.
Yeah, they're not binge spending on Amazon on Saturday night,
and so okay, what happened? Why? And we're willing to look beyond that. Where most lenders won't do that because the credit score is what it is.
Well, right, and so to that degree too, I know, and again, I would love for you to elaborate on this because I know that when you're talking about putting money, private fund or bridge, whatever, you're looking at like, well, what the equity in the property, what's the potential return, and I know credit is part of that. But when you're specifically talking about investment properties where there's cash flow, isn't cash flow king? I mean, that's the term everyone uses. Yeah. Cash is king, and then in real estate, cash flow is king. So, how important is the credit related to the potential cash flow in a deal?
No, the cash flow is important. I mean, we look at when we make a deal, what's this property going to generate in cash flow? It's got to support the loan.
Well, yeah, at least.
Yeah. So it's again, I'm sort of going beyond the what we would expect. The deal's got a cash flow. There's got to be, if it's an income producing property, there's got to be equity in the property, and so those are givens. But going back to these deals that. I don't want to give the impression that we're making loans to these crazy borrowers with bad
Well, you can't. That doesn't secure the investor's fund. So there's the middle ground. That's what I'm trying to get to. Like I know that you're saying that the credit isn't like the end all be all, but it is still important. But at the same time, the cash flow, depending on the deal, if you're trying to finance on 4 doors, well, the credit has to be there to some degree, but the cash flow has to be there. So does the market warrant the rent you're trying to get, and will it cover the costs that are going to be carried every month and every year? So
I always want to add to this. When there's a situation, maybe the credit's not so good, or there's some situation at the beginning that doesn't quite fit the normal box.
Yeah.
What we do is, because we have to get out of this.
Yes.
So we look at we look ahead, what's it going to be when the project's done, and if their credit score needs to be improved, can it be improved, and can we get out of it? And if I feel comfortable that by the time we're ready to get out of this loan, they're financeable, the exit strategy is clear. I feel good about it. I'll take the risk at the beginning if it doesn't quite fit. That's the real important to know. The exit strategy is key.
That's good because the exit strategy for you is also a new starting point for them. Because in you saying that and describing that the credit's got to get to a certain place, that means it maybe can be conventionally financed after that, or normal. I'll say more normal bank commercial financing if it's an investment property of some sort. That's good to know because it's not just like. Yeah, I think that's okay. That's really important to clarify because it's not like, hey, you're in trouble and we can finance you and then, oh, well, good luck. Like, that's not actually going to happen because you have to go down. John's looking downstream and saying, yeah, well, if downstream we can't get out of this and you can't get financed, then I can't do the deal upstream is what I'm coming to the conclusion of.
If they're not successful on the down end, we're not.
Then you won't be. Yeah, so it's kind of you all win or not.
And going back to some of these timing-related transactions, I want to just reemphasize some of our borrowers are probably the strongest bankable borrowers you're going to see. I mean, with net worths way above
normal.
And they come to us for 2 reasons: performance. They can't go to the bank. In fact, I'm doing one right now where this guy's buying a property, and he's totally financeable. I mean. But he just can't do it. It's going to take 6 months to get the loan. The bank has said...
what?
Yeah,
for 6 months?
Yeah, because there's a few other...
What seller's going to wait on 6 months?
Yeah. So what they call me, and I'm like, I'll do the deal. I mean, just because of the credit, the strength, the reputation, the credibility as borrower. And we get a lot of borrowers like that. So so you'd think the quality of our portfolio is on timing related transactions is really
makes a lot of sense.
Yeah.
Because for the amount of for the size of the fund, first of all, and the return of the fund, that's the other part, and then it has to be right? Otherwise the math ain't mathin'.
Yeah.
Yeah. I mean, is that an oversimplification to say it that way?
To say what?
To say the math ain't mathin'. Like of course you have to have some high tiered borrowers. You can't just have people that down the line, okay, we're going to help you get to that place, because you're not a credit repair agency, first of all.
Yeah.
If you're trying to finance properties, you're going to have cash flow that are good deals for your investors. So what I'm saying is, by default, you're going to have some people where timing is the main issue, or maybe predominantly timing is the main issue, and they're lendable people, but not in the time frame that which the market is going to do it at. They have to come to you.
Yeah, and I think that just shows the strength of our portfolio.
Yeah.
Again,
securing the return of the portfolio, essentially.
Both transactions end up in the same way. Their exit. Their exit strategy is solid. Yeah. We get out of it.
Yeah.
So that's the main thing. And we have not lost any since the fund started in 2019. We have no losses. We have a loan loss reserve.
That's crazy.
We manage the fund like a bank with a loan loss reserve of over 2% of total assets. We have a reserve just in case.
Wow.
It's sort of like additional insurance for the investor. If we did have to foreclose on a property, that real estate never goes to zero.
Right. I mean, the land is still worth something, even if the house ain't there. I mean, I know.
It's not like a stock where stocks can go to zero.
Yeah.
Real estate,
or your car gets totaled and it's worth absolutely nothing.
There's always value. Now, in a downturn like 2008, 2009, where values dropped 50%, we were underwater on some loans. Well, you just work.
But everyone was. The entire nation was.
But the thing is, we didn't foreclose on everybody because of it.
That's what I'm saying. The difference.
We had nobody. We used our common sense to work through it, modify the loans, work with the borrowers, give them, maybe be creative and structure the deal, put the interest on the back end, or how can we help you get through this? And real estate always comes back up. Always. There isn't anywhere in history where real estate hasn't gone down, hasn't come back up.
Right, and you kind of have to get through it together. I mean, that's just the truth of it. Yeah. You're in the transaction together from the get, and you're gonna have to be in it together through until it's not together. So there's always going to be that facet of it when it comes to lending. I wanted to ask you about something that is. You've done this a long time, right? So you've been this for 30 years. You've been managing your own funds in 2019. Like, what is something that has really stood out to you that, like, right now, if I said, John, what is one of the most memorable transactions or events that has happened to you in your career? What would it be?
I think in structuring deals, there's a few I can think of, but just in general, structuring a deal that takes creativity, that takes thinking out of the box, that is intuitive and creative, and that really just brings satisfaction to me and our team, is be able to help people, and for them to come back and say, John, we couldn't have done this without that, you looking at it this way and sort of structuring it this way. Those are transactions that are just memorable.
Yeah. So what is something that maybe has changed since you started this that you think has changed for the better? Let's go two ways here. Something that's changed for the better and something that's changed for the worse, and why? In
my industry or just my fund?
Just in your industry, like something you've noted. I mean, you're in the belly of the beast, if you will, for 30 years now. What's something that you think has changed for the better, and what do you think is something that has changed for the worse or has caused hardship?
I think there's slowly becoming more regulations in private lending.
Is that good or bad?
That's bad.
It's bad.
So that's
to people though. They think they hear that and like, oh, what are they hiding?
Yeah. So I think there's, there's just handwriting on the wall to be more, they want to get more involved in controlling this private money. So I see that possibly as a hindrance to being creative and being flexible and being able to respond to borrowers quickly. And that's a niche that we have. And I don't think it's going away, but they're slowly, the licensing and they're just adding little things every year that just sort of pick away at that. And
do you think some of those things thin out the herd from a market perspective for you, like as a company owner? Like, do you think that kind of like standardizes the entry level that people have to be at in order to perform what you're doing? Or do you agree, disagree? Where do you? Because the reason I'm asking is because we went through this as well as a company back when NMLS came out, after the great financial collapse.
Yeah.
It was like, oh, we have all this new regulation, and one of the main selling points was, oh, this is gonna weed out tens of thousands of people. You're like, yeah, it did, but then what it did is it made a lot of the bigger banks bigger, the biggest banks bigger. So what's your opinion on that for your part of this industry?
I don't think it. I think the people that actually perform are going to survive. This isn't going to make people better. I mean, private lenders. I think the private lenders that are good, they have good reputations, they're going to continue performing, they're going to survive. The guys that they're maybe there's low barrier to entry, they're not going to survive if they don't perform and they're credible and they're just consistent. Yeah. And so I think that's really the determining factor.
So then what would you say is something that is, okay, so given that might be, let's say, a bump in the road or a setback, I'm putting my own terms here just because I can't think of the right one. What is something that would cause there to be a wind in your sails when it comes to your type of financing? What's on the horizon that might be an opening or a way through some of that and to help more people?
I think to stay relatively smaller as a fund.
What does that mean number wise though? Like you just threw $70 million out a couple minutes ago. So
I would say under 200 million is that's relatively small for the industry as a whole, and being able to be nimble and for us, I don't want to go like nationwide and you have to rely on all these third parties verifications, and we like to stay local, and I think we can do that within that sphere. And so I think being smaller allows you to be better.
So local, just define local for anyone that's watching that is actually local here in San Diego. Are you talking just San Diego County, Southern California, California only? Let's tell the people what they want to know.
Okay, we can go statewide, so that's not an issue. It's do we want to go statewide? And do we, if I have enough deals locally and relationships, why would I go outside my market? I know San Diego County, like every submarket. Anybody asks me, I know the values. I sort of understand the market, where I don't know what's going on in Marin County and in San Francisco area or whatever, Northern California. I have to rely on other people, appraisers, and that's more risk. And I think for our investors, they want the most lowest risk possible, and that's our main focus is to protect our investors, make good loans, protect our investors. Yeah. And if I can do that and stay local, now if I didn't have enough demand locally, then I might look outside. But having a fund of our size, we have enough business here in San Diego County.
And hearing that explanation plus the number you threw out a second ago of anything under 200 million, there's plenty of potential transactions still in California. I'd even say just in San Diego alone, where you could absorb up to $200 million and stay right here, like in the county, within the county lines. Now, is that correct or incorrect?
No, that's correct. We'll follow our relationships. We're relationship
That's so
driven.
good. I'm glad you said that.
So if somebody says, "Hey, I got a deal in Northern California, and I've done business with this client for a long time. I have trust built, expertise. I understand. If they feel good about it, I'm willing to go with them and explore the opportunity and help them."
So that's so cool that you said that. So it's actually someone who I follow who many years ago had said, it's a franchise owner, and his whole point was, I will go for the person before the place, because the place might have the deal, but if you have the right deal and the wrong person, it's still not a deal. But if you have the right person, they can kind of go anywhere because you already trust them. There's track record. You already have worked together, and they already know what to look for and how to execute, and you can kind of like almost like drop them anywhere, and they'll probably make it work. Now, I understand there has to be a market for customers and that kind of thing. I understand that part. I'm not saying you can go to the middle of the desert and then build something and millions of people will come. The point though is that it was more about the person than it was the place they were going to. So cool little intersection there when you talk about someone who wants to go to Northern California. I already know this person. We've already done 5 or 10 of these. Like, yeah, sure, let's go.
Yeah, and it's all, like I said, I'm just saying what I said before, relationships.
Yeah.
I've repeat borrowers I've done numerous, 20, 30 loans with. And when they call me.
That many?
Oh, yeah.
Oh my gosh.
I know the
15 years, the 30 years you've been in business.
Yeah. But
wow, that's a lot.
And in San Diego, I've been doing this for 17 years in San Diego.
Just in San Diego. Wow.
So you have the opportunity to do that when you have repeat investors who are in the business of flipping properties, buying investment properties, reselling them.
Yeah.
So going back to the relationships, it's key. And I think to answer your question, it's people over the place.
Yeah,
for sure.
Wow. And it's 20, 30. I thought I was like long shotting it by saying 5 to 10, and you'll be safe if you say 5 to 10, and you're over here like, 20, 30. I'm like, oh, okay, well, I didn't want to say like 5 or 10. You're like, no, 2. So 30. So I'm clearly on the wrong side of that number. So I wanted to take a step and kind of just get your opinion. It's not opinion. It's your front of the lines perspective. Like what is something that you want that you don't yet have for your fund, for the market, for the industry in general? I want you to be able to answer that question kind of however you want. But like if I were to just say snapshot in time today, John, what is something you want but you currently don't yet have?
I don't think we have enough capital to help our clients. We have more good deals, and I have to turn away deals that I don't want to turn away if I had more capital. Mm-hmm. So right now, I really haven't been in a position since I started the fund where I haven't needed capital, which shows
demand is there.
There's demand there. We have a return clientele. We have people that know what we do, they like what we do, and they come back. And I want to help them. So the basis of answering your question, I want to help more people and help my clients. And if I had more capital, I could do more.
So what does that look like for you then, as far as, we're having our little conversation here, but what does that look like for you, day in, day out, week in, week out? Like where does that money come from? Like what you kind of described earlier, these people maybe have sold a couple properties and they just take the profit from that instead of doing a 1031 or whatever, they're putting it into the fund. Are there other sources of money that you're out looking for that people just may not be aware of?
Retirement funds. People have IRAs, 401ks, profit-sharing plans, self-directed IRAs that they could put money in the fund. So we can take that money, which is a real benefit to them because it's tax-deferred or tax-free depending on the type of IRA. But those type of funds from corporations, LLCs, so it's not just individual investments. But we're meant to be sort of a diversification in somebody's portfolio. And it's sort of like a piece of real estate secured, income producing, fixed income piece. And not, they may invest in stocks and they may invest in other things, but real estate secured piece should be a part of everybody's portfolio.
I'm wondering, and this thought just hit me. I'm wondering if there's people, and again, you don't have to say who they are or how many of them there might be, but are there people that are having a growing distrust of our financial system that are looking at this as a partial alternative? Like, is that something you've heard them say or that you've kind of recognized, like taking money away from the brokerage or away from their bank or whatever and trying to put it in other places? Is there some of that motivating them too?
Yeah, I think the risk of the stock market has sort of gone crazy over the last 5 years. Has gone up. I mean,
it's kind of hard to argue with that. Yeah,
and it's like really these values on stocks is just over the top. And I think at some point, some people are looking at that. How long is this going to last? And what's the basis? And some of these companies don't even make any money, and it's all on just perception, speculation, on speculation.
Right.
And when the stock market is based a lot on speculation, there's bound to be, and real estate, it's a hard asset. It's income producing. The worst case scenario for our investors, if we foreclosed on every loan that we had, we would own all this real estate here in San Diego, and our investors would own it, and we'd manage it for them.
Well, that's the worst case scenario. Yeah. It's like, and what would have had to happen that all of them end up in foreclosure? Like that would mean something. And we talk about this on our other show too, where I'm like, listen, sometimes we get people in the comments like, oh yeah, but da, 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 da. And you're like, listen, what you're proposing is like theoretical, but also you have to take a step back and go, something really massive in our system would have had to have happened to cause the result that you're arguing with me about in the comment section. Yeah. So that would be the same case here. Like, what would have caused an entire fund of $70 million to foreclose on all the properties? That means there's something else going awry. It's not.
It's something very. I was just sort of, an extreme situation. But the worst case is it's owning assets.
But you still have the property, and those still own all the properties.
Those assets will go back up if they went down.
Yeah, I mean, so this is the thing that, and again, this is, hopefully this isn't too much of a tangent, but this is the thing that always makes me so curious about, like, when people watch shows like this and they have conversations like this, and I read comments and I reply to people, and it's like, I don't understand the like doomsday, the market's going to crash, everything's going to zero argument, because it's like what you're saying then is all the millions of people to be affected by that, they're just gonna submit to being homeless. No, they're not. Like they're still going to have a roof over their head, whether they rent it or they buy a place. Like you're not going to have millions of people just all of a sudden wake up one day and go, yeah, you know what? I think I'm just going to live in my car. I don't want to go and fight to have a roof over my head for my wife and my husband or my kids and whatever. Like that, you're talking about like your argument is on this basis of some like psychological trend that would massively shift because of some cataclysmic event. Yeah. And I just don't think it's there. So,
but there's people that
I argue a lot about this, John.
Yeah, well,
as you can tell,
and I don't believe. I'm not saying the stock market's going to go, down. I just know that
too many important people lose a lot of money.
But it's still based on speculation on 100%. Some of these stocks.
Yeah,
some of these tech companies, they make no money and they're valued at just astronomical values.
Yeah. Well, and on the ride up, it's great. That's awesome. Yeah. It can create tax consequences, of course, if you sell stocks based on your basis and whatever. I'm not going to get into that because I'm not certified to talk about it online. Thank you. Disclaimer. Asterisk, see the comments box. I'm not a financial provider. Please, financial planner. What is it called? Financial professional. Yeah. Seek tax advice from your tax. Whatever. So the where I was going though when I asked this question is like, is there a distrust of traditional financial systems that is also drawing some money into your fund? I know it's maybe condition related. They sold and they got some money. They're converting their retirement money or whatever. But the reason I'm asking that question is because there's other parts of like lending and financing where I'm seeing other people try to do it like DIY. Like I don't want to go to Wells Fargo or Chase or B of A, and they've had these negative experiences, or they don't like what the companies stand for, and people are trying to do this like bootstrapping way of financing their life. And it's not just in real estate. That's why I'm asking the question.
Well, that's a little idealistic, a little bit. I mean, but they really boil down to, do they feel secure with who we are, and where is their money secured? They may not like big corporations and whatnot, but it all boils down to the trust level. Yeah. And it takes a while to build that trust. People want to know about you. They watch you. They want to see the performance. They want to see how, do they know other people that are in the fund, and what do they think? And it's more of just trust and making sure that they feel comfortable their investment is secured.
That's awesome. Yeah. That's really good, man. And I didn't ask you this. I guess I'm gonna try to kind of land the plane by asking some of this. Like, I don't even know what brought you into this type of lending. What's the origin story of how, like, I know we're sitting here today having this conversation about like the technical stuff, but how did this door open for you? I've
always wanted to be in real estate. So I've just since I was in high school. And so anyway,
since high school?
Yeah, since high school. So I didn't know exactly what form. I went to college, got my accounting degree, and I thought that was a good way to get into it. Got into banking and lending, construction lending, spent 12 years in commercial banking. So I got a good foundation for the corporate regulatory side of lending and understanding that I don't want to be there. Yeah. And then when the freedom of getting out of that bureaucracy was liberating. And so I got into that, and just my personality of, persevering, and, I just love challenges and having a fund. I've managed a fund, not own one, but I managed one, like I said, for 12 years, got the experience I needed, understood the business model, and then started Fidelis with the same business model, just made it better.
Yeah.
And,
wow.
Yeah, just personally, I love challenges.
Well, so what's fascinating to me is that, we talk to a lot of people in and around real estate on this show, specifically Friends of Mortgage Heroes, and escrow, title, insurance, realtors, investors, lawyers, and no one says, I went to school for this. Everyone says, it's like everyone else's story. I just fell into it. Like, that's how I became a realtor. That's how I became a loan officer. I was trying to do something else, and I was like, oh, they're doing that over there. I'll just go do that instead. I think you're the first person that's come on here, aside from the attorneys, but you're the first person that's come on here, other than the attorneys, that said, yeah, I have an accounting degree, and I went into finance. Everyone else, it's just that other story. Yeah. I don't know that someone's like at 8 years old riding their bike around going, I can't wait to be an escrow officer when I am an adult.
No, I remember looking at properties and I'd like to own something like that, and not even being close to being able to do it.
Wow, really?
Yeah.
I mean,
and it's not that I'm more into the financing of real estate and rental property. Looking at people and met people who own investment properties, and I want to get involved in this somehow.
Wow, that's fascinating.
I wasn't able to invest in a lot of properties. I got in more in the financing end of it, but it's the same thing, helping people. And I've also had my own investment properties too.
Yeah.
But yeah.
Oh, what do you know? You have your own investment properties. Of course you do. Well, okay. So one last thing. What is something that you would like to have talked about that I didn't ask you about? Is there something that we didn't cover that you think would be noteworthy, or that we should take a minute and discuss together? Anything come to mind while we're chatting?
I just think this business is fun. I love what I'm doing, and helping people is a passion. And just want to emphasize that our fund is a way to help people, both investors with their long-term retirement and borrowers, grow their portfolio, help their families, provide better housing in San Diego, provide more quality housing through our lending. So that drives me, and that's probably what I want to emphasize.
All right. So then last two things. Number one, how do people contact you? What's the best way for them to reach you? They're watching this show. They're going to see the description box. I'm going to put all your contact details in there. So what's the best way for people to reach you?
Probably just our website has all the contact information, fidelispf.com. My phone number 702-379-3468, and yeah, the website has everything.
Awesome. And then lastly and finally, I keep saying lastly. I'm like, no, that's like four lastlies, Andy. Get to the lastly. So lastly, right now we're coming into the fall of 2024. What are the deals you want people to contact you for right now?
I think ADUs, for us, that's sort of, we look at what the trends are, and we incorporate our business model and satisfy those. And right now it's housing. San Diego housing, there's a shortage, and we're there to help. And ADUs are where we can. We can't do the big projects, the multi 20, 30 unit projects, but we can do the 5, 10 units.
Okay.
And that's sort of a niche for us. And so and then really what we're going into this season, raising capital.
Yeah.
To help fund those deals, I need capital.
Basically, your matchmaking. We got on this side, the answer is we need more money. On this side, it's I need more deals, some more transactions. So the good matchmaking possibility here. You're like you are a match. I'm going to call you the property matchmaker, property and finance matchmaker. We need to make you like a social profile or something. It's just you like. This John's money dating site. I don't know. That's probably not a good idea.
So investors, investors looking for a good return. We generate over 9% annualized return to our investors, secured by real estate. So if anybody's interested, call me and I can put your money to work for you.
Secured by our continued increase of rental costs month by month in San Diego County. If you could go all the way down that line, right, John? Well, thank you so much. This has been very enlightening. I know, so some of what we talked about today, you and I have had discussions about, but I'm really glad that we could do it in this format and give a little more detail and description. And I hope that this was fun for you and informative for the audience. And John's description or his contact is down in the description box below if you would like to contact him directly about either side of the transaction for him, or either side of the relationship, not transaction, the financing side or fundraising side and investing. So John from Fidelis Pivate Fund, thank you for being with us here on Friends of Mortgage Heroes.
Yeah. Thanks, Andy.
Thank you all for watching Friends of Mortgage Heroes. Make sure to tune in next week where we have an amazing guest. Again, we interview our friends in and around real estate to help you win in mortgage and in real estate. We'll see you again next week.